Hey everybody, welcome to your week in review for the week of Monday, August 29th, 2022. Oh, what a week it was. Monday started off tumultuous. Asia sold off treasuries early and often in the overnight session, pushing the 10-year yields up over 3.13 before buyers stepped in just before 1 a.m. There was another brief lag of weakness when the European markets opened, although London was on a banking holiday. So there was a gradual improvement from 4 a.m. on, with an emphasis on gradual. MBS was still down 36 basis points when the day started. Stocks were losing as well. At the end of the day, the MBS 40.5 ended up being down 20 basis points, so we got a bit of a rally as the day went on. Though we're in the lower end of that new range that we're watching, where the floor is at 99.281, with a dual ceiling right around 100.5, though we're getting quite a ways away from that, so hopefully we don't go down and test that floor, especially if it doesn't hold, because the next Fibonacci line is all the way down at 98. All of this today was basically the market reacting to Powell saying curbing inflation will cause pain for U.S. businesses and households. It was a pretty seismic event in the stock market, which fed over into the bond market. Stock market and bonds sold off, and the Fed futures got more hawkish. They're now predicting a 2/3 chance of 75 basis points in September and only a third of 50 basis points. Also, December futures are a 50% chance that the target range will be 3 3/4 to 4%. So they've basically added about 50 basis points to the year-end Fed funds forecast over the course of the last month. The reaction to the bond market also sent the 2-year and 10-year inversion higher. The 2-10 spread is now 33 basis points. The 2-year is actually trading 33 basis points higher than the 10. And the 2 to 30s is 18 basis points, so substantial recessionary indication. Brent Nitre summarized the market's interpretation of Powell's comments like this: "We are going to raise rates higher than the market is anticipating, and we'll keep them longer than the market is anticipating, and we're going to cause a recession, and if there's a hard landing, so be it." So jobs week, so non-farm payroll is expected to come in with plus 300,000 jobs added. The ADP is going to come back this week as well with the new formulation. The last payroll release was gangbusters, coming in at 528,000 versus the expectation of 250,000. We also got a report from blockchain analysis firm Elliptic that states that more than $100 million worth of non-fungible tokens, or NFTs, were stolen in a variety of scams between January and July of this year. That's a lot of money. That's a lot of funging. Markets were down early on Tuesday, August 30th. We had the MBS down 9 basis points early in the morning, S&P down 6, and then the MBS sold off by another 20 basis points as quickly as 30 minutes. The biggest trade of the day followed a comment from ECB's Vassal saying that he supports a rate hike that could exceed 50 basis points on their next meeting. This piggybacks on comments made 15 minutes prior from ECB's not voicing support for the same. A modest but noticeable wave of selling pressure hit. MBS lost 20 basis points, being down almost 30 basis points at one point on the day. However, rallying back in the afternoon to end the day down just 8 basis points. So we're still right in the middle of that wide range of 100.5, down with a floor of 99.281. In other news throughout the day, the Case-Shiller Home Price Index showed that home prices were up 0.6% in June, which equated out to 18% year over year, which is down from 19.9% last time, though still very, very strong. The FHFA version, which excludes cash buyers and jumbo loans, was up 0.1% for 16.2% year over year, down from 18.3%. Big point here is that deceleration and decline are radically different things. Apartment List showed that rents were up 0.5% in August, so it's not like you can avoid the appreciation by not buying a house. Rents are up 10% year over year and 7.2% year to date. We also had comments from Minneapolis Fed President Neil Kashkari. Said he's happy to see the stock market reaction to Jerome Powell's speech on Friday. He was actually happy to see how Powell's Jackson Hole speech was received. Said that in an interview with Bloomberg's Odd Lots podcast on Monday, people now understand the seriousness of our commitment to getting inflation back down to 2%. pretty stubborn attitude. Since Neil Kashkari is historically one of the biggest doves in the Fed, this statement is even more impactful. Bonds are sliding toward the first bear market in a generation, burning investors who erred on bets that the central bank would pivot away from these rapid-fire rate increases. Nothing on the horizon seems like they are chilling out on large rate increases, especially if you look at the Fed Funds Index futures. As a reminder, the central bank is also closing up shop on its purchases of MBS on September 14th. The mortgage bond sector must now again learn how to ride without quantitative easing trading wheels. The Fed balance sheet has grown from $1.4 trillion to $2.7 trillion since May of 2020. That's not a percent, that's a trillion. It would be accurate to say that the central bank has essentially monetized 70% of all growth seen in the agency MBS market since January of 2020. Let's wrap that into our brains a little bit. Basically, 3/4 of the reason we had really low interest rates over the last 2 years is because the Fed is subsidizing everything with our tax money. We expect a roll-off of between 20 to 25 billion a month going forward, well under the 35 billion monthly cap. That came from Chris Maloney over at Bank of Oklahoma. Great job, Chris. We also got news that Impact Mortgage Holdings is at risk of being delisted from the New York Stock Exchange. Too many recent quarters with losses. And just like a Tuesday can turn into a Wednesday can go from flat to crap pretty fast. Fed President Meester was interviewed and used the word pain 9 times. I guess that's the code word for the Fed this quarter. She said anticipated Fed funds rate to be 4% sometime next year. It's currently at 2.5%, so there are more hikes and big hikes to come. Then again, last year she thought inflation would be about 3.5% to 4%. So maybe we don't listen to her all that much. The Fed fund continues to be more hawkish though. Futures now see a 72% chance of 3/4 of a point hike in September and a 65% chance of a total of 150 basis points by the end of the year. A month ago, the market was circling a Fed funds rate of about 3.25 and almost no chance of 3.75. Today, the market sees a 65% chance of 3.25. We got ADP jobs, which is a new formulation where they use real stats from about 25 million businesses. It showed there were 132,000 job creations on an expectation of 288,000. First reporting of this report, maybe that expectation needs to be taken a little differently. This is down from 270,000 in July and 380,000 in June, but like we said, this is a new formulation. It did show, however, that wages were up 7.6% to 9% for people who stayed in their job, but job leavers were up 16.1%. The BLS comes on Friday, that's more important, and expecting 300,000. The JOLTS report showed openings increased to 11 million, though many are double, triple counted for work for home people. We really got to get these statistics worked out. But all in all, in the day, it went from 3 basis points up in the morning to being down 39 on the day, which puts the 4.5 UMBS under par. So now we are down right at that Fibonacci line of 99.281 at the end of the day, looking to test that going into tomorrow. So we can't really rely on the market, so we got to rely on skills. So check out www.WellThatMakesSense.com and learn something new. This is a segment from How to Win Friends and Influence People. Today's post first, arouse in the person an eager want. He who can do this has the whole world with him. He who cannot walks a lonely road. So learn how to win friends and influence people by Dale Carnegie. Check it out at WellThatMakesSense.com. Then Thursday, September 1st, started out a new month, and unfortunately the new month is looking a lot like the old month, and we had some losses. Not sure we can afford to sleep anymore. Bonds keep tanking in the overnight. MBS were down 42 basis points early. Stocks were down 23 points. I mean, why? Why do people hate money? Why do people hate money nowadays? As the day went on, the stocks rallied. The bonds stayed pretty bad, but I guess less bad is better. So like I said, we were down 42 basis points early, ended up the day being down 23 basis points. At one point, we were down closer to 50 basis points, but then it came back around, got a lot better in the afternoon. I guess I should say less bad in the afternoon. Jobless claims came in a bit lower, though not so far off that it should cause this much selling. Jobless claims came in at 232,000 versus the 248,000 expected. Labor costs came in at 10.2 on an expectation of 10.7, and it was 10.8 previously. Quarter 2 productivity came in at negative 4.1 on a negative 4.5 forecast. So some bad news for inflation is productivity fell 4.1% in the second quarter. Output fell 1.4 and hours worked increased. So productivity is not helping out our cause at all. So inflation is going up and people are not being as productive. Announced job cuts fell 21% month over month to just over 25,000 according to Challenger Gray and Christmas. God, that's a great name for a company. Announced job cuts are up 30% year over year, however. We also got the ISM Manufacturing Index, which was flat in August. However, the report generally contained good news. Most notably, prices index fell dramatically and is back to June 2020 levels. So hopefully that will help with inflation. Like we said on the day, we ended up being down 23 basis points. And it ended the day at 99.06, which is still technically above that technical line, which is probably what we bounced off of today. So hopefully it stays above that, because the next line is all the way down at 98, which is going to push us over into this 5% coupon, which lost 19 basis points on the day and is basically almost par as it is. So we don't want that, because we definitely don't want to have to start looking at 5.5 coupons. We also got another post from WellThatMakesSense.com. This is from our series on how to win friends and influence people. To be interesting, be interested. Ask questions that others will enjoy answering. Urge them to talk about their own accomplishments. They are 100% more interested in their problem than yours. Great book, How to Win Friends and Influence People. You know this, and if you haven't read it, check out WellThatMakesSense.com and get the great lessons in about 8 or 9 blog posts that you can read in about 4 or 5 minutes. Unfortunately, I am going to be out of town. Well, fortunately for me, I'm going to be in Mexico on Friday. This is the big day. So we are going to get the BLS report. I'm recording this on Thursday night. So I'm going to put my forecasting hat on and I'm going to predict the future. And you're going to have to check it out and let me know how I did. So BLS is expecting 300,000 jobs. Previous was 528,000. So seeing the numbers coming in, I'm going to say that jobs are going to beat the 300,000, but we're going to get a negative revision to the previous, and there's going to be some other stuff in the middle that is just wonky, and the bond market is going to go haywire and be very volatile. So that leads us to look at next week. Next week we don't have a ton of big market moving data. We have some kind of minor players. We get ISM PMI, which is Producers Manufacturing Index, on Tuesday. That has a chance to move the market a little bit because that goes into inflation. Thursday we get the ECB statement, so we're going to get the Europe's version of the Fed making their announcement on Thursday. With as much action as we've been seeing early in the bond market and the overnight session out of Europe, this could make a big difference on things. So Thursday will be volatile. Friday we get wholesale sales and inventory, which will play a little bit into inflation. But it is a long weekend, so nothing coming on Monday. So you have some extra time over the weekend. I hope you have fun. I hope you be safe, and you check out some of our influences and sponsors right down here. Take care, everybody.